You open your banking app on a Tuesday morning. You are not expecting anything unusual. You are standing in your kitchen. Coffee is still brewing. You have not even sat down yet. Then you see it. Your portfolio is down 11% before the market even opens. Your retirement account lost more in the last 16 hours than you saved in the last 3 months. You read the number twice because your brain refuses to process it on the first pass. You refresh the screen. The number does not change. Somewhere on a television in the background, a man in a suit is telling you to stay calm. He is talking about fundamentals. He is talking about long-term perspective. He is talking about not making emotional decisions. You already know he is not talking to you. He is talking to someone who can afford to wait. You are standing in your kitchen trying to do math that does not add up. This moment is not rare. It is not a once-in-a-generation event. It is a scheduled reality. And the brutal truth is that most people were never given the tools to survive it. You were not undisciplined. You were not naive. You were simply handed a system that was designed to perform during stability. Nobody told you what happens when that stability ends. The financial world sold you a single idea: diversify. 60% stocks, 40% bonds, a target date fund that slowly shifts as you age. A company match you set and forget. That was the plan. That was supposed to be protection. What they did not tell you is that in a systemic crisis, bonds and stocks fall together. In 2008, nearly every traditional asset class dropped in correlation. The 60-40 portfolio did not save anyone. It just lost slightly differently. That is not protection. That is two bets on the same system failing at the same time. This is the conversation about the Doomsday Portfolio. Not a bunker, not a conspiracy, not gold buried in a field behind your house. A real, structured, mathematical framework for protecting your wealth when the machine breaks down around you. Here is the number that anchors everything. According to the U.S. Bureau of Labor Statistics, gold doubled in value while the entire financial system was collapsing. Between 2008 and 2012, gold rose over 100%. At the same time, the S&P 500 lost nearly half its value at the bottom. Two assets, same crisis, same window of time. One wiped out a decade of savings, the other quietly doubled. Most people never positioned themselves to benefit from that. They were told to ride it out. They rode it all the way to the bottom and spent the next decade recovering what they lost in 18 months. The Doomsday Portfolio is not about predicting when the crash comes. It is about not needing a prediction. Here is how financial crises actually work. They do not send an announcement. You do not get a warning email from your broker. By the time the news anchors are explaining what is happening, the institutional money has already rotated out. Large hedge funds, sovereign wealth funds, central banks. They do not wait for permission. They move in advance. They move on signals the average investor never sees. They watch credit default swap spreads widen. They monitor stress in the overnight repo market. They track the velocity of short selling in financial sector stocks weeks before a headline breaks. By the time that rotation shows up on a television chyron, you are buying into a falling market and calling it a dip. The average retail investor loses wealth in every major crash for one core reason. They were never positioned to survive the first 72 hours. Everything they owned moved in the same direction when fear entered the market. Stocks fell. Their bond allocation fell with it. Their real estate lost liquidity overnight. And the emergency money printing that followed eroded the purchasing power of whatever cash they kept on the sideline. Every layer of their protection failed at the same moment. Not because they were bad investors, because they were sold a framework built for a world that never stops growing. That world does not exist. The financial system is not designed to protect your wealth in a crisis. It is designed to manage your wealth during stability. Your advisor collects a fee whether your portfolio grows or shrinks. The fund manager charges a percentage of assets whether the market goes up or down. The brokerage makes money on every transaction, whether you are buying at the top or panic selling at the bottom. Nobody in that chain has a financial incentive to build you a fortress, so you build it yourself. The Doomsday Portfolio runs on one principle: non-correlation. You do not need the highest returning assets. You need assets that do not collapse in the same direction at the same time. That is the entire framework. The first pillar is gold. Not a gold mining stock, not a leveraged ETF, physical gold. Or a fully allocated, audited fund where your metal exists in a vault with your name attached to it. Gold has no earnings reports. It cannot go bankrupt. It cannot issue a surprise press release about accounting fraud. It does not need a functioning banking system to hold its value. When the financial layer of the economy loses credibility, gold simply exists outside of that credibility problem. Gold is not an investment in growth. It is an investment in the persistence of human trust in something that cannot be printed. That distinction matters enormously when central banks are choosing between austerity and the money printer. History has a consistent answer for which one they choose, and gold has a consistent answer for what happens to its price when they do. Here is what matters most. The people who run the global financial system are buying it right now. Global central banks have purchased over 1,000 tons of gold for 3 consecutive years. The institutions managing the world's most powerful economies do not fully trust those economies. That is the signal. You follow the behavior, not the press release. The second pillar is short-duration government bonds or treasury bills. When markets crash hard, capital floods into safety. Treasuries become the most crowded trade in the world. Prices rise as everyone else is selling everything else. You want to already be inside that trade when panic arrives, not scrambling to find liquidity while your other assets are in free fall. Short duration matters because it limits your exposure to interest rate movement. You are not betting on rates. You are parking capital somewhere it will not disintegrate under pressure. T-bills are boring. That is the point. In a crisis, boring is a feature, not a flaw. The third pillar is cash. Not a philosophical statement about keeping some savings. A real, dedicated, untouched cash reserve. 6 months of living expenses at minimum. 12 months if your income is variable or your industry is cyclical. 18 months if you are a business owner or freelancer whose revenue can evaporate with the broader economy. Cash in a crisis is not dead weight. Cash is the only asset with purchasing power when everything else is being sold at a discount. Cash lets you survive without touching your investments at their lowest point. Cash means you do not have to make a panicked, irreversible decision at the worst possible moment. Most people make the worst financial choices of their lives not because they are irrational, but because they ran out of options. Cash is what keeps options alive when the market is trying to take them from you. The fourth pillar is where most people never go. Real assets, commodities, energy, food infrastructure. The physical world does not stop functioning because financial markets are on fire. People still need electricity on the day the S&P drops 20%. Supply chains still move agricultural products when a major bank collapses. Farmland does not become worthless because a hedge fund is getting margin called in New York. The price of oil does not care about a liquidity crisis on Wall Street. Owning a stake in what the physical world requires to operate gives you a floor that paper assets simply cannot offer. You do not need to buy a farm. You can access this exposure through diversified commodity funds, energy infrastructure trusts, or agriculture-linked ETFs. The point is allocation. Even a small percentage of your portfolio anchored in real production changes your risk profile in a meaningful way during systemic stress. Now here is the twist that most people never consider. The true cost of not building this portfolio is not just the money you lose during the crash. It is the money you were never positioned to make coming out of it. Think about this carefully. When the 2008 crash bottomed out in March of 2009, the best equities in the world were selling at historic discounts. Blue-chip companies trading at 4 times earnings. Real assets priced as if the global economy would never recover. Banks that were not going to fail were trading as if they already had. The investors who survived the crash with purchasing power intact did not just survive, they bought. They doubled their equity exposure at the bottom. They loaded up on assets that had been unfairly punished by panic and margin calls. They came out of that crisis with portfolios that outperformed every benchmark for the entire next decade. Not because they were smarter, not because they got lucky, because they had the resources to act when everyone else was paralyzed by fear and loss. That is what non-correlation actually buys you. Not just protection, it buys you the most valuable resource in a financial crisis: optionality. The person who holds cash and gold when the market is down 40% is not just safe, They are dangerous, in the best possible way. This is the gap that the consumer financial system was never designed to show you, because showing you this gap means admitting that the standard model fails, that the 60/40 portfolio fails, that riding it out is not a strategy. It is advice that serves the advisor's fee structure more than it serves your future. Financial crises are not accidents. They are consequences. They emerge from debt cycles that expand beyond their structural limits and then contract violently. The 2000 crash, the 2008 crash, the 2020 crash. Each one was preceded by years of visible stress that the consensus chose to ignore. Each one created the same outcome for the unprepared, and each one transferred an extraordinary amount of wealth from the people who were fully exposed to the people who were quietly positioned. That transfer is predictable. It happens every single time. The only variable is which side of it you end up on. You do not need a PhD in economics to read the cycle. You need a posture. Start with a rough framework. Allocate a meaningful percentage of your net worth to physical gold or a hard asset equivalent. Build a cash reserve that is genuinely usable and mentally ring-fenced. Add short-duration bonds as a liquid safety layer. Keep your equity exposure diversified and unlevered. Increase your allocation to real assets over time as your wealth grows. Review and rebalance at least once a year so that a strong equity run does not quietly concentrate your risk back into a single system. The percentages will depend on your age, your income stability, and your proximity to needing the money. There is no single correct answer, but the direction matters more than the exact allocation. The direction is away from full concentration in a single system's continued health. The direction is toward assets that do not all require the same conditions to survive. The goal is not to profit from disaster. The goal is to still have choices when everyone around you has run out of them. The wealthy do not fear recessions. They have been quietly positioned for them long before the headlines arrived. When the crash comes, they are not calling their advisor in a panic at 11 in the morning. They are reviewing their allocation and identifying what to buy next. They have already done the hard, uncomfortable work of preparation. So when the moment arrives, they feel something that almost no one else feels during a financial crisis. They feel ready. You are not behind. You are not too late. But the window to build this is before the next crisis. Not during it, not after. You cannot buy fire insurance while your house is already burning. When the next market breaks and the people around you are asking what to do, you want to already be the person who built the answer long before anyone thought to ask the question. There is more to understand about exactly how to allocate for different crisis types. Inflation crises erode cash and reward hard assets differently than deflationary crashes do. Currency crises require an entirely separate layer of thinking that most domestic investors have never been taught. Geopolitical shocks move markets in ways that none of the standard models account for. Each scenario has a different playbook, and understanding those differences is what separates the portfolio that survives from the one that just endures. If this changed how you think about your money, there is one more thing you need to see. Most people build the Doomsday Portfolio and then make one critical mistake. They protect their wealth from the crash, but they leave it completely exposed to what comes after. The inflation wave, the currency debasement, the silent erosion that happens while the markets are recovering and everyone is celebrating. That is the next video. It covers exactly what to do with your protected capital once the crash has passed, how to deploy it, when to move, and why most investors who survive the crisis still end up losing ground in the decade that follows. Hit subscribe so you do not miss it, because the crisis is only half the battle. The rebuild is where the real money is made.